Welcome, financial enthusiasts and curious minds alike. Today we're diving into the wisdom of one of the greatest investors of all time, Warren Buffett. Known as the Oracle of Omaha, Buffett's investment prowess has earned him a place among the world's wealthiest individuals. With a track record that spans over 6 decades, his strategies have consistently outperformed the market, turning a struggling textile company, Berkshire Hathaway, into a multi-billion-dollar investment conglomerate. His philosophy is simple and straightforward, yet remarkably effective. And today, we're going to unpack the 12 golden rules of investing, according to Warren Buffett. These principles have guided his investment decisions, helping him amass a fortune while navigating the turbulent waters of the stock market. So buckle up as we delve into the first rule of investing according to Warren Buffett. Rule number 1. Invest in what you understand. This is a cornerstone of Warren Buffett's investing philosophy. Imagine you're at a local farmer's market. You're more likely to buy apples from a vendor if you know they're fresh, crisp, and grown without harmful pesticides, right? It's the same with investing. If you understand the business or industry you're investing in, you're more likely to make informed decisions. You wouldn't put your money into a high-tech startup if you don't understand what they do or how they make money, would you? By investing in what you understand, you're not just following trends or taking wild guesses. Instead, you're making educated decisions based on knowledge and insight. It's like knowing your apples before you buy. Remember, knowledge is power, especially in investing. Are you enjoying the video so far? Don't forget to hit that subscribe button and ring the notification bell so you will never miss any of our exciting personal finance contents. Rule number 2, long-term perspective. The allure of quick profits can be tempting, can't it? Instant gratification, that's what it's all about these days. But let's take a leaf out of Warren Buffett's book, shall we? He's a stark advocate for the power of long-term investing. Remember his words? Our favorite holding period is forever. Now that's a statement. Unlike the erratic thrill of short-term speculation, long-term investments are like slow-cooked meals. They take time, but boy, are they worth it. By focusing on the long-term potential of your investments, you give your assets the chance to truly flourish. So, the next time you're tempted by the quick buck, remember Buffett's wisdom. It's not about the sprint, it's the marathon that counts. And in the grand race of investing, having a long-term perspective could be your winning stride. Patience, my friends, is indeed a virtue in the investment world. Rule number 3, margin of safety. Now you might be wondering, what's this about a safety margin? Well, it's not about maintaining safe distances on the highway, but it's just as crucial in the world of investing. This rule is all about seeking investments with a margin of safety. Now imagine you're at a carnival, and there's a guess the weight game. You'd want to guess a range, not a specific number, right? That's your margin of safety. In investing terms, this means buying stocks or assets when they're undervalued. It's like getting a designer suit at a discount store. You're paying less than what it's actually worth, and that's your safety cushion against potential losses. It's about minimizing risk and maximizing gains. So, remember, just like you want a safety net while trapezing, you need a margin of safety in investing. Always have a safety cushion, because investing isn't a fall-free zone. Rule number 4, quality over quantity. Warren Buffett, the Oracle of Omaha himself, holds this principle dear. He urges investors to focus on the quality of companies rather than the quantity of investments. But what does this mean? Think of it this way. Would you rather have a single diamond or a bag full of pebbles? The diamond, right? That's because the diamond is of high quality and holds significant value. The same applies to investing. It's better to invest in a few quality companies with strong competitive advantages and reliable financials, rather than spreading yourself thin across many investments of questionable value. Investing in quality means looking for companies with solid financials, strong market positions, and sustainable business models. These are the diamonds in the rough of the investment world. They may not be as flashy or as numerous as the pebbles, but their value is undeniable. Remember, it's not about the number of investments but the quality. Rule number 5, buy businesses, not tickers. Now, what does that mean? Well, it's quite simple, really. Warren Buffett encourages investors to view stocks as more than just ticker symbols on a screen, but as actual stakes in real businesses. Imagine you're buying a piece of a pie. You wouldn't just buy it based on the color, would you? No, you'd want to know what's inside, the ingredients, how it's made, and whether it's a flavor you'd enjoy. Similarly, with businesses, you're not just buying a stock, you're buying a slice of a company. You're becoming a part owner. So, it makes sense to understand the fundamentals of the business you're investing in. What does the company do? How does it make money? What are its prospects for growth? When you view your investments this way, you're more likely to make informed decisions and less likely to be swayed by market volatility. Don't forget to hit that like button if you're finding these insights valuable. Rule number 6. Consistency and predictability. Now this is where Warren Buffett's keen eye for detail comes into play. He has a preference for companies that have a history of stable financial performance. These are the companies that don't just have a one-hit wonder product but have demonstrated their ability to generate revenue consistently over time. Consider it like this. It's like choosing a marathon runner over a sprinter. The marathon runner, while not as flashy or fast, has the stamina and the consistency to keep going. Similarly, companies with a consistent track record of performance are more likely to keep delivering returns to their investors. And predictability? Well, it's about understanding the business model and being able to reasonably predict how the company will perform in the future. With consistency and predictability, you're not just gambling on a hunch, you're making an informed decision. Consistency, folks, is not just key in life, but also in investing. Rule number 7. Competitive advantage. This is where we delve into the idea of a durable competitive advantage, or as Warren Buffett likes to call it, the moat. This moat is a metaphor for the defensible barrier that a business has against its competitors. It could be a strong brand name, a unique technology, or even a superior distribution network. This moat protects the business from the onslaught of competition, allowing it to maintain its profitability over the long term. And just like a castle's moat prevents invaders from getting too close, a business's competitive advantage keeps competitors at bay. The wider the moat, the harder it is for competitors to penetrate and destabilize the business. It's this moat that helps the business to sustain its profits and deliver long-term value to its investors. So before you invest your boat, look for the moat. Rule number 8. Strong management. Just as a ship needs a skilled captain to navigate turbulent waters, a company requires robust management to steer it towards success. Warren Buffett, a seasoned investor, underlines the significance of assessing the competence of a company's management team. Why, you may ask? Well, even the most promising business can falter under lackluster leadership. On the other hand, a capable management team can transform an average company into an industry leader. They make the strategic decisions, they set the course, and their vision shapes the company's future. And remember, Buffett's wisdom isn't about finding a company with good management alone, it's about finding an excellent company with good management. So, next time you're analyzing a potential investment, don't just look at the numbers. Take a closer look at who's at the helm. Great management can make or break an investment, and that's the essence of rule number 8. Rule number 9. Ignore market noise. You've probably heard the clamor, the panicked whispers when the market dips, the exuberant chatter when stocks soar. But the Oracle of Omaha, Warren Buffett, reminds us to tune out this cacophony. Why? Because these short-term market fluctuations are just that, short-term. They're the result of speculation, rumor, and emotion, not of solid long-term business performance. This also applies to popular trends. Just because everyone is rushing to invest in the latest hot industry or stock doesn't mean you should follow suit. Remember, Buffett's strategy is all about understanding the business you're investing in, not jumping on bandwagons. So, how do we ignore the market noise? By focusing on our investment principles, doing our own research, and maintaining a long-term perspective. Remember to keep your cool, even when the market is hot. Rule number 10. Avoid overtrading. The Oracle of Omaha, Warren Buffett, advises against the frequent buying and selling of stocks. And why is that, you ask? Well, it's because overtrading can result in higher transaction costs and potentially lower returns. Imagine you're at a bustling market, swapping goods left and right. It might feel exhilarating, but every swap comes with a price tag, and these costs can add up quickly, leaving you with less than you started. Similar is the case with overtrading in the stock market. Additionally, overtrading could be a symptom of a lack of strategy or discipline, which is a big no-no in the world of investing. It's like trying to catch a swarm of bees with a butterfly net. You're more likely to get stung than to succeed. So remember, the stock market isn't a game of musical chairs. Trade wisely, not frequently. Rule number 11, cash is a position. Warren Buffett, the sage of Omaha, is known for keeping a significant amount of cash on hand. Now you might be wondering, why would an investor of his caliber sit on cash? Isn't cash meant to be invested? Well, yes and no. You see, having cash on hand is like having an ace up your sleeve. When the markets are in turmoil, that's when opportunities arise. And to seize these opportunities, you need cash. It's like having a magic key that can unlock doors that are usually closed. Buffett uses this strategy to buy when others are selling, snapping up undervalued assets and making a profit when the market inevitably rebounds. So the next time you're feeling the pressure to invest every last penny, remember rule number 11. Having cash is like having a magic key that opens doors during market turmoil. Rule number 12. Stay rational and patient. It's the final rule from the Oracle of Omaha, but it's by no means the least important. This rule is all about keeping your cool, not letting emotions dictate your investing decisions. As exciting as the stock market can be, it's not a place for impulsivity or reckless abandon. Think of it as a game of chess, not a roll of dice. You need to strategize, anticipate, and most importantly, wait for the right moment to make your move. The stock market, much like life, has its highs and lows. It's a roller coaster, but one where you can't just jump off whenever you feel the ride is too intense. You've got to strap in, hold tight, and keep your eyes on the horizon. Warren Buffett himself said it best: the stock market is designed to transfer money from the active to the patient. So, stay rational, stay patient, and let the market do its thing. Remember, the stock market rewards the patient. And there you have it, the 12 Warren Buffett rules of investing. Let's do a quick recap. First, invest in what you understand. Second, maintain a long-term perspective. Third, always seek a margin of safety. Fourth, prioritize quality over quantity. Fifth, think of stocks as businesses, not tickers. Sixth, value consistency and predictability. Seventh, look for a competitive advantage. Eighth, consider the strength of management. Ninth, ignore market noise. 10th, avoid overtrading. 11th, remember cash is a position. And 12th, stay rational and patient. These rules are not just pieces of advice but principles that have guided one of the most successful investors of our time. They emphasize the importance of understanding, patience, and discipline in the world of investing. So, take a leaf out of Buffett's book and apply these principles to your investing journey. Thank you for watching. Hope you found this video informative and entertaining. Don't forget to like, share, comment, and subscribe to our channel for more financial insights.